Torsten, it's great to have you on the show. Welcome. What's the thing you're watching most closely in this jobs report?
Well, the key issue is that last year the narrative in markets was that there were headwinds to the economy coming from the trade war. But those narratives have really changed dramatically now. Instead, people are talking about that headwinds coming from AI spending, from industrial renaissance, and perhaps the most important tailwind is that the one big beautiful bill started kicking in on January the 1st, and that is, according to the CBO, going to lift GDP growth this year by 0.9%. So what I think that we should be looking at is that there is an increasing risk that the economy might actually begin to accelerate over the coming quarters, in particular as businesses begin to take advantage of the immediate expensing, meaning you can write down your capex this year, and therefore we should see some more hiring, we should see some more capex spending. So the answer to your question here, Morgan, is we should expect to see the labor data over the next several months get better.
It's interesting to hear you say that, Torsten, because we've gone from trade war to kinetic war. So how does that factor in here when oil prices are spiking?
Yeah, so that is, of course, the more recent development that we, of course, need to try to take into account. But the key issue continues to be that the underlying health of the U.S. economy is that the economy is very strong, and we should expect to see that begin to accelerate and show up in an acceleration in employment over the next several months. Yes, we also have the added issue that immigration has been restricted quite significantly over the last 14, 15 months. But it still is the case that if you do still have an economy that's getting, and especially with all the AI spending that continues to run in the background, that should all be pointing to a labor market that just continues to get stronger.
Yeah. So a stronger labor market. But what does it also mean for the inflation piece of the puzzle? When we had a hotter than expected PPI reading next week, we'll be looking to CPI or last week, and we'll be looking to CPI next week. And again, we know energy can, if it stays prolonged at these levels, can funnel through to other aspects of those readings.
Yeah, and that's right, Morgan, because this species sets us up for an economy that went from last year was in stagflation, meaning we saw higher prices and more downward pressure on GDP. Now it's the complete opposite. Now, if we just agreed that there's some tailwinds to growth, and on top of that, as you just highlighted, we both had PPI was stronger, we get CPI next week. That is actually pointing to upside risk to inflation. So suddenly we have an economy that's a risk of overheating. And that's, of course, creating a lot of challenges for the Fed, because the Fed has been for numerous meetings now pointing to that the next move in rates will be lower. And of course, now the market is beginning to say, well, maybe we'll get a little dip lower in rates, but the Fed meeting in 2 weeks, we could suddenly begin to hear Powell talk about, well, if the economy is strong on the labor market, if the economy is strong on inflation, well, maybe they should begin to think more about at least keeping rates flat. And maybe later this year, even we will begin to talk about that the Fed may have to hike.
Okay. That was literally the question I was going to ask you, and that was the fact that the Fed funds futures market seems to be pushing out the possibility of a rate cut to September this week. But you're saying maybe that's completely off the table, and if you have an economy that's running hot and starting to push through with stickier inflation, it could be the opposite situation altogether?
That's right, Morgan. And what's also very important for investors to remember in the near term is that normally households in the U.S. get around $3,000 in tax refunds. That's here in March and in April as we all file our tax before the April 15 deadline. But this year, because the one big beautiful bill was done retroactively, meaning starting on January 1, 2025, that means that we have all paid too much in taxes for 2025. That means that all of us will get a higher tax refund than what we did last year. And that is likely to also lift consumer spending and therefore retail spending over the next several months. So we're going into a summer where the market is set up for the risk is really more that the economy is getting stronger, not only on the broader GDP measure, but including also on consumer spending.
Torsten, we're out of time, but when I hear you lay all this out, this is why yields are moving higher.
Exactly. And that's exactly why, as you just pointed out in your rundown of the data that we're seeing at the moment, the dollar is higher, yields are higher. Of course, equities are still thinking a lot about AI. The index has implied vol that's very, very low, but underneath the hood, single stock vol is very, very elevated. So there is in equity still a very strong discussion around what is the role of AI, but the broader macroeconomic backdrop is very clear, namely that things are looking pretty good.